We're back, everybody. It is annual renewal time on my very first policy. So let's dive right in and talk about it. What's up, everybody? JDew here, and we're just getting into March of 2022, and that means it is annual renewable time for me. See, in 2016, around this time, it was actually March 11th, I believe is the day, I got my first infinite banking cash compound type policy. So I put that into the vault, right? I'm using a lot of jargon terms here, but I want you to know that that's how it all started for me. Now that is 6 years ago. So I chose an annual premium at that time for my very first banking policy. And so this is my 7th payment. So you get how that works, right? 2016, 17, 18, 19, 21, 2. I needed to make sure. So this is my 7th payment inside this policy. Remember, you can pick any type of premium mode you want in the 4 choices of monthly, quarterly, semi-annual, or annual. You can change them around anytime you want to as well. Obviously, when you call into Jake at State Farm and say, hey man, let's go from quarterly to annual, let's go from annual to monthly, if you want to do that with Netflix, it's totally fine. Okay, so I have an annual number that I pay, and I just got my notice. It is go time. So if you're looking at this in terms of the timeline, about a month or so prior to your annual renewable date, the insurance company will give you a kind of an update check sheet. So I just got mine from my very first company, and I chose a premium. I'll even give you some numbers here on that very first policy that I got. I chose a premium of 10 grand. So let me break down for you what they sent to me. It's going to be really helpful for some folks who have done a little bit of homework to understand. And maybe if you're brand new and you're interested in getting a policy that you can build wealth with, that you can utilize cash value right out of the gate with, this is going to help you think about it a little bit. So first off, there are 2 components of my premium. Premium is always red cup, right? Cup 1, red cup, is where we put in our dollars. That buys us the policy. It buys us the death benefit. It helps us work toward equity, cash value, every time we put premium in. But our dollars go in premium. The premium is split in 2. And it's split into base premium and paid up additions, PUA. Okay, so all of that is constructed by the broker, by the agent when they put it together. So for everybody joining us who is newer, and we're starting to get this question all the time, you don't have to do any of this. You don't structure it. You don't structure it. You can't structure it. That's not your job. So it's going to be broken down into base, premium, and PUA by your agent who's setting you up for banking. If you need to do it, call us. We're ready to get you started. We take care of this process. So my original policy, of course, I didn't build this policy myself. This was new to me in 2016. Has a base premium of $4 grand, and it has a paid up additions rider on it from the gate out of the starting blocks of $6,000. So that makes up my $10,000 annual premium. I can change it right now to a monthly premium, $830 a month, right? Basically the same deal, but 4 base, 6 PUA. So my notice, my annual premium says that my base premium is 4. That's what I have to get in the policy to keep it in force, to keep it working and growing for me. 4,000, 6,000 in flexible PUA. So the company that I'm working with for this first banking policy that I own privately says I can pay that or not pay that anytime over the course of the year. So it does not have to go in all at once. It does not have to go in all up front. It can go in any time. And the other thing that it says is how much money I have outstanding from cup 2, my cash value cup, my green cup. Remember, we're building policies and helping other people build policies they can utilize the cash out of, starting right away. So this particular policy, I'm going to actually tell you how much cash value I have outstanding because they sent it to me. Okay, the cash value that I have outstanding on this policy is $44,000, just over $44,000. So I've borrowed their money, Green Cup, out of Cup 2. It's not my money. All right. There's a lot of folks who need to be reminded of that all the time, that the money that I'm borrowing in cash value is not my money. The reason the cash value keeps going up and compounding for me is because my dollars are still in the red cup, premium cup, compounding. So that's why cash value or equity value keeps rising, as does the death benefit. Awesome. One day I will be gone, and that death benefit that has been rising my whole life, get it, will also be available to my family, friends, church, or charity. So I have $44,000 outstanding. Remember, this cash value is mine to use. It's equity. I can use it for anything that I want anytime. And because it is already guaranteed as death benefit, I'm borrowing against my policy. I'm actually getting my death benefit, and I'm not even dead. So because of that, I am borrowing. There are implications around borrowing. A lot of folks need to hear this again. There are implications around borrowing. I can have the money, I can take it, I can use it, but I am borrowing money from Cup 2, cash value, and so there are ramifications. The biggest ramification is that the insurance company assesses an interest rate annually to the amount that's outstanding. So this particular company has an interest rate that I can handle for two reasons. One, it's 5%, and I can do that math in my head. And secondly, it's not as high as several other companies. We broker here at the Cash Compound. We use multiple companies to pull this off, and not all companies choose the same annual loan interest rate. They also have the ability to change that from year to year. All of the companies basically that we've used over the course of our time helping people design policies like this and building their wealth, they don't really change the numbers. So 5% is the number. It's always been the number since 2016. So that means, ladies and gentlemen, listen closely. That's a lot of words to help you understand the numbers again. Once again, I'm putting minimum $4,000 into this policy. If I add all of the PUA of 6,000, that'll be 10,000. Okay. That's the first section. Second section of this is how much loan interest the company is going to assess me this year for having this outstanding loan. That outstanding loan is just over $44,000. So at 5%, that means $2,200 is what they are assessing to that loan. Here's the question. Do I have to pay it? Do I have to pull that money out of pocket and pay $2,200 on top of my $10,000 to keep my policy? The answer is no. I don't have to. Okay. Now it's a good thing too. We'll get there and all that, but just making sure I answer the question specifically is no. Okay. Here's a question I have for you. If someone guaranteed that you'd have $44,000 that you could borrow from them, utilize for whatever opportunity you wanted, we're talking buy a home with that money, put some money down for it. We're talking crypto. Maybe you got some investment that you'd like to do. We're talking give it away as a gift to someone else. If they qualified you without any paperwork, without any credit check, without any business plan to borrow $44,000 from them, and you didn't have to pay it back in your lifetime at all, would you give them $2,200? What if they said, if you give me $2,200, I'll give you $44,000 to work with in whatever way you see fit? Maybe even an investment opportunity where you could make more money, but it's going to cost you $2,200. You can take $44,000. Would that be a good deal? Would you do it? That's the question for you today. I think that's an okay deal. So I'm going to do it. Okay. I think I can have a lot more going for me with $44,000 working for me in some fantastic way, or an investment in myself or my business, or maybe even a gift for my kids. $44,000, and it's going to cost me $2,200. So that's one way to be thinking about how this works. So if you add all those numbers together and I do pay it, because I would pay $2,200 to get $44,000. That means 4 base, 6 PUA premium plus $2,200, $12,200. That is my money that I plan to pay back to the insurance company. Does that make sense? So once again, the $2,200 is extra. I'm just giving you a fantastic way to think about what's going on and giving that money to the insurance company, letting them keep it in their coffers for them building this type of system for you and guaranteeing that it's going to work for you and grow for you year after year throughout your life, which life is financial. You're going to need money at any point in your life, and this is how you can utilize that. So if you can think about that for your thought of the day, that's where I am on this first policy. I have $44,000 outstanding working for me right now. I've got a base premium that I have to pay of $4,000 to keep this policy. Lots of flexibility from the $10,000 that I said I wanted in premium back in 2016. $6,000 extra dollars is PUA to puff this thing up to allow me to have cash that I can use and get access to even from the beginning in the very first month of this policy. And a loan interest rate due back to the insurance company for doing this deal for me, $2,200 at an interest rate for the year. So I wanted you to think about that, ladies and gentlemen. So wish me luck. I'm going to keep this thing going. I think that's a great thing. Maybe you think it's a great thing too. We'd love to help you get this started and help you understand infinite banking, get your specific custom questions answered. I'm happy to pick up the phone for you, or one of the banking bros and the guys in our office who pick up those phone calls. So we'd love to help you crack the code to cash flow.